In the latest episode of the All In podcast, there was criticism from David Friedberg about fintech in general and Metromile in particular. So let's take a listen to what they said and we're going to break it down.
And a lot of, quote, fintech businesses are looking like fin businesses without the tech, meaning their margins and their LTV to CAC, or their return on invested capital, it looks the same, or in some cases worse than the traditional financial services businesses that they're meant to disrupt. I always used to sit at the board meetings at Metromile and I would scream, guys, if we don't demonstrate margin advantage, the business will eventually trade like the market trades, which is 1 times revenue. And if we trade at 1 times revenue, we're already overvalued and we've burned so much money. It was always a challenging conversation about pulling up the margin, pulling out the LTV to CAC numbers.
So I found this to be a particularly interesting conversation because they mentioned Metromile in particular, which is a company that Friedberg founded and which Chamath Palihapitiya actually invested in. Ultimately, that company was acquired by Lemonade, which is a company that we're very bullish on here at Rebellionaire. But let's acknowledge where Friedberg's right. First, a fintech company isn't a SaaS company. And so he's absolutely right that if you're an insurance company, for example, and you have to pay out a certain percentage of your revenues as people have claims, then of course your gross margin profile is going to look a lot different than a pure SaaS company, which you can just sell the software for almost a 80-90% gross margin with very little incremental cost for each new marginal dollar that you get. So that difference between a SaaS company and a fintech company is very much legitimate. And so I don't think you should be using the same kind of multiples to be looking at these types of business. Second, if you can't get your core business right, then of course you're in for a reckoning. So he mentioned Metromile in particular in some of the meetings where they just couldn't even get their payout ratio. So for those who maybe aren't familiar, the payout ratio is essentially how much are you paying out in claims per dollar in revenue that you're getting in. In Metromile's case, this was actually over 100% for a while. So you're paying out more in claims than you're getting in revenue. If you can't fix that problem, then it doesn't really matter what the rest of your business looks like, because that's just a kind of core problem with the actual functionality of the tech part of your fintech business. But beyond just that, he also broke down the LTV to CAC ratio. This is a really important number and one that maybe some of you aren't familiar with. So let's take a second to break it down. The numerator of that equation is LTV, or customer lifetime value. That's the LTV. The lifetime value is essentially the revenue minus the cost that it takes to serve that customer. So in insurance, let's imagine that you're collecting $100 in premium from that customer every year, but you're paying out an expected $75 in claims that the customer might have. So that would be $25 per year. And let's just say you have that customer for a number of years, and then you discount the sum of all of those years back to the present value. That's the LTV. So essentially, for every new customer that you bring in, what's the present value of all of their revenues minus the expenses to serve them? So that is essentially how valuable is every customer that you're bringing in. The CAC portion of the equation is in the denominator, and that's the customer acquisition cost. So let's say you have a customer lifetime value of, let's say, $300, and the cost to acquire every new customer is $100. So that's how much money you would have to spend on marketing to bring in each new customer on average. In that case, your LTV to CAC ratio would be 3. So it's 300 divided by 100 is 3. And that's indicative of a reasonably healthy fintech company, because essentially your marketing spend results in pretty meaningful incremental value that you're bringing to the company. In Metromile's case, though, they didn't have the LTV component of that, right? As I said before, they were essentially paying out more in claims than they were even bringing in for premiums. So the LTV component of that was just completely backwards to begin with. And then on top of that, as Friedberg indicated, the customer acquisition component of that was also getting a lot more expensive. So you can have great top line growth numbers, but if your core business is as inherently flawed as Metromile's was, at least back then it doesn't really matter how fast you're growing, because you've got bigger problems. But that doesn't necessarily mean that Metromile was inherently overvalued. And I want to take a look at the way the company looked at the time that it was acquired by Lemonade. So Shai Winiger actually tweeted about this. Shai is one of the co-CEOs of Lemonade. And at the date of closing, he indicated that the stock price that Lemonade was paying to Metromile shareholders. So this was a stock transaction, meaning that existing shareholders were diluted a little bit. That $145 million of dilution to existing Lemonade shareholders resulted in a cash balance increase of $155 million. So kind of right off the bat there, that strikes me as a pretty good deal. You're getting more in cash than you're paying in dilution. On top of that, there was $110 million in new car premium. So think of that as revenue that's going to be recurring and it has the potential to grow over time. They also acquired 49 state licenses. So that's another kind of barrier to growth that they were able to just essentially acquire. So rather than going state by state and trying to register with, all the different state agencies, they essentially acquired their way into being able to sell insurance in 49 states, which is a very big deal for Lemonade. And then they also got data from 500 million car trips. Anyone who knows AI understands that data is the new oil. It's extremely valuable. If you want to train your AI to get better so that you're not paying out more in claims than you're bringing in revenue, data is an extremely important way to do this. So essentially, when you break it down like this, I think it seems pretty clear to me that this is a pretty good deal for Lemonade. I mean, the cash part alone makes it seem like a really good deal. The only way that this really couldn't be a good deal is if Lemonade is unable to bring down those loss ratios and the auto business just continues to drain cash. And it essentially becomes a business that is inherently fundamentally flawed and just has no hope of redemption. I don't think that's the case. If you actually look at Lemonade and their history, every time they've launched new products, they start with high loss ratios and they bring those down over time. So I think there's no reason to think that that won't be the case. There were also some specific items with auto insurance in California in particular, where rate increases were not being approved by the state regulator there, which actually forced a lot of companies, insurance companies, to leave or significantly reduce their business in California. So part of this is just a kind of timing issue with COVID and the inflation that we had there. But these rate increases are going to be coming, which is going to help to improve the fundamentals of the business. Let's look at LTV to CAC ratio in the context of Lemonade in particular. So Lemonade, the business as a whole, so not just the auto insurance business, but also the home insurance business. They've got a car and a pet renters insurance business. But if you look at the combined business, Lemonade has disclosed historically that they have an LTV to CAC ratio of around 3, which is certainly quite healthy. We were surprised, though, in Q3 of 2023, which is the most recent quarter that Lemonade has disclosed, that management actually indicated that their LTV to CAC ratio has improved to around 4 in recent quarters, which is a big surprise. So I actually had a chance on the Q3 earnings call to ask management about that improvement, and here's what they said.
I wanted to touch on your LTV to CAC ratio. You mentioned pretty significant improvement getting to greater than 4 in recent quarters. It looks like this is related in part to the more efficient marketing spend that Tim touched on. But can you give some additional color on what things the AI is picking up on to drive the LTV component of that equation higher?
Definitely, this is one of our lower spend quarters, and the systems are very good at cherry picking. So the incremental dollar will be spent as close as possible to the incremental LTV to CAC. I think we've been reasonably good at getting, sharpening our pencil, systems getting better. The more markets we deploy and the more products we launch, the more optionality the system has in order to cherry pick. So I do hope that we'll be able to continue to improve.
So in summary, Lemonade is actually able to demonstrably improve their AI that prices their insurance. In fact, they actually call each new iteration of their AI pricing models an LTV model. So LTV 6 was launched in Q2 of 2022. And now with the benefit of realized data in hindsight, we can actually see, and Lemonade was able to validate, that the assessed loss ratios, so the loss ratios that were actually realized for the new cohorts of customers, which were priced with that LTV 6 model, were actually assessed with an extreme degree of accuracy. So they were predicting loss ratios in the 71 to 68% range, and those numbers were actually hit perfectly. In fact, I think the 68% number was slightly better than the predicted value for some of the cohorts of customers. So the newest iterations of their models are actually improving the pricing quite well, which is indicative that the LTV component of the LTV to CAC ratio is working quite well. But it's also worth noting that management's not stopping there. They're continuing to work on their pricing. Their LTV 8 is the newest model that is actually being used to price customers. So we're going to see the benefits from that in future quarters. And LTV 9 is in the works right now. It might have even been shipped. We'll find out in the latest company earnings call. The trend is very clear. They're getting new data. They're finding where the model was inaccurate before. And then they're using those lessons to feed more data into their pricing models, which improves the LTV portion of the LTV to CAC ratio. And so all of that just really validates that the LTV side of Lemonade's business is quite healthy. As Daniel said on the earnings call, the AI is also extremely adept at cherry picking valuable customers. And that essentially validates the CAC side of the LTV to CAC equation. So if you're kind of looking at this data and extrapolating forward, there is so much that's going to Lemonade's benefit here. So they're continuing to grow their customer count. Each new customer that they're bringing on is going to be priced more accurately than the historical cohorts. So the AI is just getting better and better, which means that over time, as you get more newer customers and renewals come in that are now priced with the better AI data, the loss ratios should very much come down, which certainly helps your LTV to CAC ratio. So it's just a very exciting trend. And while I think Friedberg's comments on All In were definitely valid, that you need to look at a fintech company a lot different than a SaaS company, but you also can't just throw out the baby with the bathwater and say, okay, all fintech companies are overvalued and we should kind of avoid these. And there's certainly this trend, if you're looking at Lemonade's stock price history, that, oh man, look how much it's fallen. It's got to be a bad company. If you ignore the stock price and instead look at the fundamentals of the business, look at how their AI is improving, look at their revenue growth rate compared to their operating expense growth rate, it becomes really clear that what they're actually doing is building an AI substrate that's able to handle extreme levels of growth in the future without extreme levels of increases in overhead costs. So this is one of the reasons we're so excited. Their AI is just getting better and better at pricing. Their marketing is getting more and more adept at finding customers who are valuable and really targeting those marketing dollars with extreme precision. And then if you just look forward and try to think of the business, how it's going to look when auto is available in more states, when home insurance is available in more states, and the ability for customers to buy these higher priced products, which in some cases can be 10 times more revenue for like a home product than a renter's product. It's extremely exciting to think about the future that Lemonade has. So this is not financial advice. We are financial advisors, but we're really just kind of sharing our thoughts here. If you're interested in learning more, check out Rebellionaire.com. We're happy to work with customers who are not thinking about things in the kind of traditional Wall Street way of diversifying every name down to like 3%. So if you're interested in learning more, check us out at Rebellionaire.com. I'm Matt Smith. Thanks for watching.